Welcome back to M2M, the podcast covering matters of current affairs that have implications on investments and the markets. Today, we're going to talk about the oil slick that is fast spreading across the Middle East. With me, as usual, there is Manoj, our insightful expert. We're going to talk about what's happening with the Middle East crisis, the impact on oil prices, and various sections of the economy.
Hi Ram. So oil is slippery and so are the markets. Just when we thought that the RBI has given a bonanza, inflation is in control, things are looking up. We have Israel bombing Iran, and with that, oil prices shooting up. Uh, Markets haven't reacted very badly, but if oil is going to touch the figure mark, as many of experts are uh, worried about, then it can uh, be quite a bit of problem.
Yes, Manoj. Brent crude is now at 75, and once it touches 100, things may go a bit haywire. The Straits of Hormuz are at stake here, and Iran is threatening to take out some of the ports that the countries have. 25% of global oil trade passes through that, 20% of LNG gas passes through that. So a lot depends on how the war is going to play out. So what I think is that the way things are fast evolving, Israel wants to take out the regime in Iran, and Israel definitely is under threat with so many ballistic missiles overwhelming their air defense. And the US seems to be willy nilly getting pulled into this war. And um, I mean, the clear end game, they seem to have a clear end game. They want to make sure that the last gram of enriched uranium is taken out in Iran, and US may enter with its big bombers and blow the schmoozles out of the underground facilities, etc., etc., which only US can do. Israel can't do. Israel has done whatever it can, and Israel is definitely taking US's support, because if Iran lets loose all of those ballistic missiles, then there'll be significant carnage in Israel. So we are at a. The interesting thing is that the markets are not wildly gyrating or reacting. Maybe the algos and the large AI models are predicting what's going to happen, and there's a lot of liquidity that is kind of pushing up the markets. But um, we got to see, if there is a major bout of uncertainty, like for example, some sort of a nuclear incident, then the markets may panic. So I feel that the markets believe that a change in regime may be a long-term positive, because um, there'll be less uncertainty going forward. There'll be less uh, altercations between Israel and Iran, and things will be a little bit more stable. Though I personally feel that this whole regime change business is not easy. It's extremely messy. It took 20 years for Iraq to stabilize. So there'll be a lot of chaos, but still, maybe the perception is that even that chaos is better than having a nuclear armed,
Iran.
bully in the region. That's my what. What do you think about that?
Well, honestly, I was also surprised to see the markets not reacting as extremely as they normally do when we encounter a geopolitical situation.
Right.
Uh, However, whether it will continue to stay that way or the volatility will increase will depend on how things pan out. Okay, particularly at least in the short term, I think markets will be driven more by how oil behaves. And while the war might continue, we don't know who is planning what and who will gain the upper hand, etc. But if this conflict persists and oil goes up, then there are far reaching implications for both global and Indian economy. You mentioned numbers of global trade, and if I'm not wrong, up to 40% of oil and about 50% plus of gas that India gets is through that port. And that might have major implications for the country. Of course, see, we have all have strategies, and Indian refiners have already started looking at options like West Africa, etc., for alternative sourcing. We still buy most of our major part of our oil from Russia. So Russia, West Africa, but the tensions will escalate, and which will mean oil will even if we are buying from some other place, we'll be buying at a much higher price, and that will
Absolutely.
have implications.
Absolutely. I mean, we import 85% of our oil, and the oil bill, which is at 85 billion, could go up to 105, 110 billion, if this kind of price rise happens. And that's going to have a proportionate impact on the GDP. Every $10 rise in oil price, as they say, increases the whole price inflation by around 90 bips, and consumer inflation by at least 25 bips. So this whole, in the last episode, we were talking about you know, the excellent rate cuts that came and boost to the end. Unfortunately, right after that, these events have transpired. So looks like there will be some temporary blips on the growth radar, right?
Yes, almost every single macro indicator will get adversely impacted. Okay, as you rightly said, increase in oil means increase in inflation, which in turn means increase in interest rates. That means lesser amount of disposable income, lesser ability to take loans. That means drop in consumption, so drop in GDP. Higher payment for oil means higher trade deficit, which means probable weakening of rupee. That can mean FIs withdrawing money before all this happens to protect their dollar denominated returns, which means again impact on capital market flow. So this cycle, with just one thing going wrong, a whole lot of things will get impacted. So this is worrisome. While we hope that this conflict will not last long, while we hope that things will be in control, oil prices will remain steady, uh, we need to brace up for things that probably might not be in our favor, at least in the short term.
Yeah, let's talk stocks now. Airlines, paints, logistics. Uh, these are clearly some of the most oil price sensitive industries. And I mean, airline, for example, 40% of the cost is fuel. So those could be impacted. So some of those stocks, are worth watching if this oil price gyrates. Um, though, like I said, it depends on how much the Strait of Hormuz comes under pressure, uh, how long the war takes, how messy it gets, etc. So, assuming that there is going to be regime change, in a fairly fast way, we can take a best case scenario. The worst case is that yes, the GDP could get impacted. We could easily see 0.1 to 0.4% downgrading of the GDP growth. So on the other hand, oil producing and upstream companies may benefit, but then that's in the bigger scheme of things, that's a relatively small part of the economy. So, so what do you think investors should do in this scenario?
Okay, see, when you are investing in equity, you need to be prepared that there will be times where things can get choppy. Okay. Moreover, a lot of things will depend on how things pan out. For all you know, for so many years now, the Indian government has increased the excise duty and kept the oil price for the retailer consumer like you and me above a particular level. Okay, which they could have actually reduced. They are using the additional revenue for capex. Now, if the government perceives that an increase in oil price can be more damaging, they can probably take a hit, reduce the excise duty, and keep oil prices relatively stable. But the flip side is capex will get impacted, and so will GDP growth. So dynamic, and the companies, airlines, for example, you mentioned, they might still be buying in the market, so they will eventually have to shell out a lot more. So these impacts will happen, as you said. So from an investor perspective, your question specifically, what should investors do? Investors need to tighten their seatbelt, pull up the socks, and wait for things to stabilize. We've seen umpteen number of times that there will
Absolutely.
be crisis, there will be market volatility, but end of the day, growth prevails,
Yeah.
and therefore markets kind of move towards, um, continue the movement upwards. So if at all, if there are sharp drops, I will stick my neck out and say they can be buying opportunities.
Yes, we've seen the Iraq War. We've seen the invasion of, when this was in the 90s, right? Um, umpteen number of Middle East crises have come and gone, so this will be one more. Long term uh, wealth creation is a long term thing, right? So I definitely agree. One would need to stay invested, and but yes, there could be a bumpy ride ahead. So will oil touch 100? Probably yes, probably no, but definitely the risks are rising. We got to fasten our seatbelts and monitor the situation and stay invested.
Yep. Would have loved to say happy investing, but maybe we'll resist that and say careful investing.
Careful investing
But do
and
remain invested.
and see you in the next episode.